So the one thing that isn't going to be hard for you today is we are going to get into the Wealth Webinar Series every single Wednesday, 1 p.m. Make sure you tell your friends about this, share this, because this is free knowledge, folks. This is where I get to literally teach you wealth hacks like what you're going to learn today. I get to teach you the secrets of the wealthy. I get to teach you all the things out of my books, whether it's the Private Money Guide or Mapping Out the Millionaire Mystery. I get to show you what I've learned by failing over and over again, and by being a financial advisor for 16 years on Wall Street. I get to literally teach every single one of you and help every one of you get better at money and learn how money really works. And what we're going to do today is something that I'm incredibly passionate about, and that is buying cars. But I did it all wrong, folks. You see, we're taught to buy cars one of 4 different ways, right? What are the 4 different ways we can buy cars? Let's go through them. Number 1, you could take money out of your bank and you could pay cash for a car, which means you can exchange cash for the car. You can drive the car away, and the second you drive it off that new car lot, it depreciates and you lost 20, 30% of its value, right? We all know the routine. And buying a car cash, most people that you speak to, most wealth advisors, CPAs will tell you that that's a terrible way to buy a car, because you lost the earning potential and the opportunity of that money you had because you gave it to the dealership or the person selling the car in exchange for a car that's going to depreciate. Cars are one of the fastest depreciating things out there because we use them every day. So that's a bad option. So option number 2 is lease the car, right? Leasing is relatively new. I remember the first vehicle I leased was I think it was a Chevy S10 ZR2. And that was my first lease, my first experience with leasing. And I did it because it reduced my payment. That's all I cared about, was the lower payment. I didn't care about the fact that I was just giving money to the dealership's finance company, and then at the end, they just took the car back. I wasn't focused on that. I just wanted the car now at a payment I could afford. So leasing, became part of my life, and I started leasing and using the third method. But we all know what leasing is. You exchange monthly payments for the right to drive the car based on the amount of mileage that you're allowed. And if you go over those mileage, God forbid, but if you don't, you got those mileage, you turn the car back in 3 years, and they give you another lease, and you keep repeating that cycle, and you're trapped forever. You're just always exchanging money. And that was, for some reason, folks, correct me if I'm wrong, but doesn't that payment always seem to go up when you're leasing? Like you're leasing a car at $200 a month, then the next car is $300 a month, the next car jumps to $500 a month, the next car is $700 a month. You get the drift. It just never seems like the payments stay the same. And we really never really upgrade too much on those cars. It's almost like a trap. So leasing is popular among business owners because our CPAs tell us, oh, you can write the full lease payment off. But then there's another option, right? Option number 3, you can finance the car. You can buy a car. You can take it to your local community bank, your local credit union. You can take it to your local bank, or you can just have the finance company at the dealership finance that vehicle for you. And they'll find a bank, and they'll take points and spread and all that stuff off of those loans. They make a bloody fortune on financing. And all we do then is we exchange monthly payments and a deposit in most cases, a deposit and monthly payments in exchange for the right to drive the car, own the car in 5 or 6 years, whenever that is. So that probably is the most logical way we buy cars. And that's the number 1 way that I've bought cars, that and leasing. Okay. But then there's the 4th way you can not buy cars, but get cars, is you could steal a car. You could. I mean, let's be honest. Hey, if you wanted a car bad enough, you could go steal the car. You'll probably go to jail. I'm not going to teach you how to steal cars. I'm going to show you how I learned to buy cars. And I learned it from someone by the name of Brent Kessler. Okay, and he showed me this, and my eyes went, I literally looked at that, and I'm just like, oh my God, there it is. The dollars and the idea hit me. I was so pumped about this because I'm like, I can get all the money back for all those Audis that I've been buying, and I didn't know about this before. That's where the story begins. So now what I'm going to show you, and I want to be clear about something. I want to be very transparent about something, is this system I'm going to show you doesn't mean that when I show this to you tomorrow, you're going to be able to go buy a car in this way. This system takes a little bit of time to capitalize, and you're going to see that. Not a lot of time. I'll show you my system. And it's funny too, because I had to actually, well, I'll get into that when I show you the slides, but I had to kind of take all my old plans, and I had to put them all together to show this the most accurate way. Not only that, I'm not going to just show you how I bought the cars. I'm going to show you what cars I actually bought. That's how much I love this. So there we go. Let's jump right into this thing. So I'm going to share my screen with you. So with that, here we go. We're going to dive right into this thing. So this is all about buying cars. I've already explained that. Okay. There's different ways to buy cars. There's different schools of thoughts for buying cars. This is simply a way that I've learned how to buy cars. It's a wealth hack, if you will. It's a secret of the wealthy on how it can be done, but it is so simple. It is so simple because it involves one change in your life. That's it. All you need to do what I'm doing is change one thing. And that one thing, we'll get into that, is where your money goes first. That's it. It's where your money goes first. You're already doing this, folks. You're already doing this. You're giving money away to somebody else every single month for your lease payments or your car payments right now. True or true? We are. You're already giving up money every single month for your cars. Some of you are giving up large chunks of money every 5 or 7 years to pay cash for a car. And some of you are giving up monthly payments to rent your car, commonly known as leasing. But we're all doing this, okay? And the other thing that we're all doing is all of us have some method in our lives of saving money. So all of you are saving money somehow, some way. Think about it. Where's your money going? Okay. So you get your paycheck. It's netted out for taxes. Netted out for taxes. And then you get your net paycheck. And then that net paycheck goes places. The car payment, the mortgage payment, the car insurance, all those things. But some of that money makes its way to a savings vehicle. You can see the evolution. We went from a $20,000 car to a $45,000 car to a $63,000 car during different periods of time in my life. The $63,000 car just happened at the end of last year, 2019. And that is my wife's car. It's not my vehicle. It's my wife's vehicle. Okay. It was the car she wanted. I'm going to talk about that as we go through it. So those are the 3 different cars that I bought. Now, this is how most people would do this. Now, we know that there's these different options to buy the car, throw out the stealing the cars, because we're not going to go into that, but conventional financing. Getting into it, car number 1, that was how it shook out. So I took a loan for $20,000. It was a 5-year loan at 5% APR. This isn't how I bought it, but this is just how I summed it up. So that was the vehicle, 20 grand, 5-year loan, 5% interest rate. The payments, $416 a month, $5,000 a year. Total amount you would pay in interest on a $20,000 car financed with a conventional bank over 5 years is $2,917. So that would be the first car. So what is the second car? The second car is that $45,000 Audi. 45 grand. If you finance that at a bank, a conventional bank, it would be a 5-year loan. Now, why does the interest rate change? Well, folks, this is real life. 2007, interest rates were higher than they were in 2012, correct? Think about that. 2012 was right after the Great Recession. The Fed dropped interest rates, so 3% was actually a pretty common thing to buy a used car and pay 3%. So I just want you to see a $45,000 loan for 5 years at 3% is $875 a month, $10,000. And also too, you can see right down at the bottom, folks, just to be full transparency, in case any of you grab these numbers, go to bankrate.com and you're like, Chris, those aren't the real numbers. Yes, they are. They're right off bankrate.com, but we included tax and title. Can you buy a $20,000 car and not pay tax on it? No, absolutely not. So folks, these numbers, these payments include the taxes on the car in New York State, which is, I believe, 8.25%, and registration of the vehicles. So I went all out. We didn't miss a beat on this. So that second car, if you finance that $45,000 car over the full 5-year period at a low interest rate of only 3%, you still gave the bank $3,806. $3,806. Now let's just do some quick math. I want you to understand this. Now that might not seem like a lot. You're like, actually, that's pretty good. The interest rate's really low. I would do that. 3,806 divided by 60 months. Folks, you're giving up $63 every single month in interest. Now that may not seem like a lot, but let's put all this together at the end. And folks, it adds up super quick. It was a 6-speed. Thank you, Adam. So that's the second car. What is the third car? It's my wife's SUV, which we'll get into the types of these cars, because this one is not an Audi, but it is an evolution of Audi, owned by the same company, but a little bit different. It is a Porsche. Okay. So the principal on this Porsche was $63,000, 5-year loan at 4.5% is $1,084. And actually there's a typo there. The one thing that you're seeing here, and I want to be clear because I know these things very well, this should be a 6-year loan, because a $63,000 car, most people are going to do a 6 or even a 7-year loan. So that shouldn't be a 5-year. It should be a 6-year loan. We'll change that slide. But right there, over 6 years, your payment would be $1,084, $13,000 a year. You just gave up $9,758. So now let's just do this. 9,758 divided by 72 months means you are paying $135 every single month in interest to somebody else for a vehicle that's going to depreciate. That's what I want you to start thinking about. It's not about the car payment. It's not about the car. It's about how much money you're giving away to everybody else. And we got to change that one thing. And that one thing will then allow us to put that money back into our banking system. The total interest that you had paid for these cars, 5 years, 10 years, and 16 years. So 16 years worth of car ownership, 3 cars, you gave up $16,481. $16,481 over 16 years. So 16 years divided by 12 months. Well, we're not even going to, it's not even important, but that's how much money you gave up to the banks. Okay. And what did you do with the cars? Well, you drove them, you used them. Some of them you crashed, some of them you sold. You did different things, but it doesn't matter. The bank, without having to do anything, without having to work any harder, without having to really do anything other than make you a loan, made $16,000 off of you over that time frame. Sure, many of you are thinking, cost of doing business, Chris, cost of car ownership. Yes, until you learn this. Now, here's my way. So this is how we buy cars now. This is how Hannah buys her cars. This is how Brent buys his cars. This is how I buy my cars. This is how Adam's going to be buying his car. And this is how many of you are going to buy your cars. So watch closely. Now, in order to buy cars, okay, you have to, if you're going to pay cash for a car, you'd have to save that money. So back when I did this, and just so everybody knows, what we're looking at here is just a privatized banking system. Now, in 2007, I had banking policies, okay? They weren't like the ones I designed today, but they were still banking policies because I was in this business, so I had these. And what are these things? For those of you that don't know what we're talking about, what we're looking at here, these deposits, okay? I don't care if it's a bank account that you want to do them from, but I want to get uninterrupted compound interest. So what we're looking at here, and let me kind of get my little drawing tools out, okay? What we're going to kind of focus on is this deposit right here. 18,000, which is $1,500 a month, okay? 18,000 works out to be $1,500 a month. Where did that $1,500 a month that I was saving? Because it is a deposit account. So I was depositing the equivalent of $1,500 a month into a series of different banking policies. So what is a banking policy? Some of you might be asking. It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Not the normal whole life like you would buy off the shelf at your life insurance store. These are built for banking. They're built to operate and work much like your conventional savings account does, okay? However, unless your savings account pays you a guaranteed 4% plus dividends every year, your bank account doesn't beat my bank account. Now, there's a downside to my bank account. So your bank account, actually, if you're using a conventional bank account, which most all of us have, including myself, if you're using a conventional bank account, if you go to the bank and you deposit $1,500, the first year you have access to $1,500 because you're probably not getting any interest, right? In my banking system, the one you're looking at here, in the first couple years, I don't have access to all of the money that I put in. But it's really okay because if you're saving money in a savings account, how many times do you make a deposit and take all the money out? How many times do you do that? Very rarely do you ever deposit money and take all the money out. So this account, I put in $18,000 in the very first year. Okay, after I put in $1,500 a month, I have access to roughly 61% of my money. Okay, $10,990. So that's how much money's in my savings account. So most of you would be like, yeah, but that's not 18,000. I'd rather put money in my bank account, my regular bank account. Okay, so if that's what you're thinking, great. But just stay with me because your regular bank account doesn't pay you uninterrupted compound interest. So I did this for 3 years. I put in 18,000 year one, 18,000 year two, and in the third year, as I was making those deposits, what I did is I took a $20,000 loan from my specially designed and engineered whole life policy. From here on out, for the rest of this training, I'm not going to call it a specially designed and engineered whole life because it doesn't just flow off the tongue. I'm going to call this a banking policy. Okay. Just like my bank account, this is a banking policy. So I took 20 grand out, and what did I do with that 20 grand? I bought a car. Now, I showed you in the prior slide, if I had gone to the bank and financed the car, I would have had to make monthly payments for that car. But what I did is I was just saving money every month. Okay. I just saved between multiple policies because this isn't just one policy. This is several policies. I basically had been putting money away into these different policies for many years. So I basically had put that 18 grand in. And at that point in time, I would have had, if you added these two numbers up, I would have had $40,603 in my account at the end of the third year. But somewhere in that third year, what I did is I took 20 grand out. Now, I want to be very clear because I'm just showing you how to buy cars. Here's the reason why I use these specially designed banking policies. You see, this $40,603 that I have in my account that is earning a guaranteed 4%. That's 4% interest is what I'm earning on that money right there on this $40,000. Sorry if it's a bit scratchy in terms of how it looks, but that $40,000 is earning 4% plus dividends. So the number I use for this policy is 6.2 because that's how much the dividend and the interest works out to be today. So my money in this plan is earning 6.2%. Now, dividends are not guaranteed. We are using non-guaranteed values here, but the dividends are what they are and what they have been. Matter of fact, they were lower back, or they were higher back then. So I'm just using today's numbers. So if I took 20 grand out, so if you had 40,000 in your bank account and it was earning 6.2%, you went in and you took 20,000 out, how much would you be earning interest on? Well, 20,603, right? That's how much interest you would be earning. You'd be earning interest 6.2 on this amount. But how much am I earning interest on? I'm earning interest on the 20,000 that I took plus the 20,000 that's in. So the full 40,603. So how can you do that? How can I earn interest on 40,000 when I just took 20,000 to buy a car? Well, this is where the magic starts. And I have another video that teaches that, but the insurance company gives me the ability to use their money. So I take a loan from the insurance company's general account, which they've got way more money than I do. And the insurance company just uses my $20,000 as collateral, but they agree to continue paying me interest and dividends on the full amount. They're agreeing to pay me interest and dividends on this full 40,000, even though I took 20 out. So that is key. That is very important as to why this way of buying cars works so well. You see, what happens is in the first couple of years, it's not going to make a huge difference. But over time, what you're going to see, I have a perpetual tailwind. What is that tailwind? It's something Albert Einstein called the eighth wonder of the world. Okay. Something that he said was the most powerful thing in the financial world, or the financial universe. It is called compound interest. But you see, what I'm doing is I'm earning uninterrupted compound interest because this money that I have never stopped earning interest even though I took it out. So I just wanted to help you understand what's happening because I really just want to show the mechanism of how this buys cars. But you need to understand that there's always going to be interest and dividends paid on my full amount, not the amount minus the car purchase that I made. So if we do that and we basically look at these numbers now that you understand kind of what's going on, I took 20 grand out, but now you see this $5,000 car loan payment? You're probably thinking to yourself, why would I have a car loan payment if I paid cash for the car? Well, because this is my bank, folks. This account that you're looking at, it's my bank. I treat my money the same way that I treat the bank's money. And when I borrow 20 grand from my local conventional bank, they don't just say, hey, Chris, you can have the 20 grand, don't pay us back. Do they? No, they say, here's 20 grand and here's the monthly payment of $500, or in this case, 416, I believe it is. You got to pay us 416 a month. So if I was okay paying 416 a month to their bank, why would I have a problem paying $416 to my bank? The $18,000 that I was saving every year was already money that I was saving already. It's not new money. It's not like I had to go find that money. It was money that was going into my savings already. It was automatically taken out into multiple policies. So the $5,000 you see on there is that $416 that I would have given to the bank if I took out a car loan. Now I just pay it to myself. And folks, this is the fun shit. Excuse my language, but paying yourself is way more fun than paying the bank. And here's why. You see this $5,000 every single year? Every single time I pay myself $416.16 to drive my car, I put $416 a month back into my account, okay? So that $416 goes back into my value. Every penny of that $416 is mine to use tomorrow when that check clears. How much more fun is paying $416 a month to yourself and getting to use it versus giving it away to someone else to drive the car? It's way more fun. And it works way better because, hey, when you become the bank, when you actually start taking back control of your money and stop giving it away is losing control. Taking back control is paying yourself. So I'm just paying myself every single month the same amount that I would have paid a conventional bank to buy this car. So what is the outcome? So what happens? So I've been putting $18,000 into this savings program, right? And it's not 18 all at once. You know, you could do it all at once. I did it monthly, which worked out to be $1,500. It was actually several accounts. So I did about $500. Okay, let's just round it and make it easy. $500 a month into 3 different accounts. And that was okay for me to do. I could afford to do that. Okay. And even though back when I did this car, I didn't have a ton of money, but I was still able to save. I've always been a good saver, and all of you should be as well. So what happens now is as we kind of move through this, you'll see we have put some money into our account. So how much money do we put into our account? I got to get my clicker to work. There we go. So over 7 years. So the first 2 years, I had to capitalize my account. So if you were looking to buy a car tomorrow or this year, you would have to pre-capitalize your account. You would have to dump money into your account all at once to get it ready to buy a car. And people do this all the time. But the way I did it is I just put money in every single month and I saved up. And when I had enough money to buy that car, I actually had more than enough money. I took 20 grand out and I used it to buy this car. And so over 7 years, the first 2 were just capitalizing. The other years were just me contributing and depositing money in my savings. I put a full $127,000 away over a 7-year period of time. It seems like a lot of money, but folks, when you break it down, it's really not. It's what all of us are probably putting somewhere else anyway. Then how much money did I pay back to myself? $5,000 a year. Okay, $416 a month for that car payment, but the car payment got paid back to myself, so that was $25,000. So $126,000 plus $25,000 was $151,000. So into my banking system, I deposited with the deposits and the car loan repayments, $151,000. There's the car. It is I don't remember what year that was, but it was a Audi, and actually that was an Audi A8. It was a several-year-old Audi A8. I don't remember, how many year old it was, but it was a $20,000 car. Had lots of miles. You see, one of the things I always did with my Audis, I wanted the nice one. That's a beautiful car. But that car had well over 100,000 miles. Otherwise, I couldn't have got that car for 20 grand. So I only wanted to have the car for a period of 5 years. The thing broke down all the time, but that's beside the question. Let's see, pay it back monthly to yourself, your banking policy. Correct. So I've got some questions, and let me just take a moment and in a second, and I'll answer your questions. I just want to finish my thought, and then we'll explain it. So I put $151,000 into my banking system, $126,000 in deposits over 7 years, $5,000 a year or $416 a month because everything is monthly, $25,000 for that car. So over 5 years, I paid $2,000 or $20,000 for the car, but with financing, it cost me roughly $25,000. I rounded up. So, but then out of that $25,000, what else happened? I had to buy the car, didn't I? So out of the money I put in there, the 151, I took 20 grand out and I bought the car. Therefore, my net injection into my banking system, which is the deposits I was making just on a regular basis, okay, for no apparent reason, I was just saving money for the future. That was the 151 plus the car payments, okay, which was the $5,000 a year, minus the car was 20 grand. I put a net injection of 131 into this banking system. And during this period of time, I drove that beautiful car right there. Okay, that was at my house out on Cherry Street in Lockport, New York. That driveway right there was filled with these little Audis because that was my little bad habit. But this car, The cash value growth after the purchase of this car. So now let's look at the cash value. Let's focus just on this column here, cash value. After 7 years, how much money do I have in my bank account? 116,343. 116,343 is in my account. So how much did I put in? 131. How much do I have? 116. So I literally, for that car you're looking at, this is the very first car I bought with this system. That car, that Audi A8, whatever year that was, I got 89 cents back for every single dollar I paid for that car. And I still, you got to remember, after the end of this, I got 89 cents back for the car, but I still owned the car. A lot of people confuse that and say, well, wait a second. Yeah, you got 89 cents because you sold the car. No, no, no. The car was in my driveway. I just got 89 cents back for every dollar I paid for it. Now, let me ask all of you a question. How many of you have ever bought a car, had the car for 5 years, and then had 89 cents back for every dollar you paid for that car, plus the car was still in your driveway? Well, very few people, unless you're a car collector or you're somebody that buys cars and renovate or fixes them up and like gets the equity back, most all of you have never actually even known how to get 89 cents back for every single car you've ever bought, driven, and owned. So that's not too bad. But here's the problem. That's not 100%, is it? I said I'm going to show you how to get every dollar back for every single car you buy, drive, and own. And now we're going to go on to car number 2, but let's come over here and just hit a couple of questions real quick. So first, when and how do you have to repay the $20,000 back you took out of your policy for the car? So that's a good question. And I did answer that, David, but that's okay because a lot of people probably have that question, but they maybe haven't yet gotten to the conclusion of that. So remember, this $416 a month that I'm giving to my banking policy, I'm taking that $416 every single month and I'm depositing it back into my account. I'm repaying this loan that I took from the insurance company. But when I repay the loan, my value goes back up. The access to my capital goes back up. So all I'm doing is I'm just repaying myself the exact same way I would repay a car loan with the conventional bank, dollar for dollar, same terms, same monthly payment. Nothing changes with what you do right now when you buy cars if you're financing your cars. Exact same strategy. So now let's talk about the next car. You see, now we're going to move on and we're going to buy the next car. There it is. This beast cost me $45,000, way too much money. And part of the reason why I got myself in trouble and I was way over leveraged. But that car was a $45,000 car. But you see, I had already had this account. That first Audi that I had, the A8, what happened is after that period of time, I sold the A8. I got rid of that silver A8. I sold it. But remember, all the money I sold that for was pure profit. So what I normally would do is I would kind of flip cars the way I flipped real estate. I'd sell the car. I would take the money. I would basically put it back into my banking policies or use it somewhere else. And then I'd buy my next car. And it's funny. So it's so unique that I've got somebody like from my early years that actually kind of watched this whole thing happen from afar. Adam pretty much saw every Audi I had, and he's probably always like, well, we got another one. But this is how I was doing it. I was flipping cars. I was buying cars this way, and then I was basically taking the money when I sold the car to recapitalize my system. So the thing that happens for most of you, this isn't my story, but for most of you, after 5 years of having a car, the car needs new brakes. The interior starts getting a little worn out from the winters and all the use and abuse. You need new tires. The oil changes keep coming up and you're just, they just lose that new car smell. To be honest, like when you walk into a dealership and you open the door and you close the door in a new car and you sit there behind the new vehicle that you're thinking about driving, you're sitting there and you're looking around, you're like, this is nice. Leather seats feel good. Everything's brand new. But then you take a big sniff. It's that new car smell, folks. That's why we buy cars. So whether it's an Audi or whatever car you're buying, after 5 years, folks, the new car smell's gone. And those little air fresheners, those new car scent air fresheners, they just don't do it for you. So you need to buy a new car. Well, in year 8, I had sold that other Audi A8, and now I needed my new car. And there she is. An S4 Avant, all customized. So I was putting 18,000 in, and we're just going to repeat the process here. So I just want to be clear about what we're going to do because I'm going to go faster now that you understand what's happening. So here, I didn't have 103. I had 148,000 So I had 148K, well, 148,001 that is earning 6.2% with dividend. Okay. 4% guaranteed with a big G, and then 2.2% dividends. I'm just using today's numbers to keep this really simple and keep myself compliant. So these are the numbers for today. Back then, the dividends were actually higher. So that's what you're earning on 148,000. Now, some of you are probably like, well, why are you earning 148 when you've only got 103 in there? Because remember, you earn money on every single penny that's in your account, even when you take that money out. So now that we've got that clear, let's kind of go through and let's look at the numbers on this. So I did the same thing. I took the 45,000 out. I bought this beautiful Audi and I was driving it, but I would have paid that. I would have paid a finance company equivalent of $10,500 a month. That's how much I would have paid for this car if I was to finance it. So all I did is instead of paying somebody else, I paid myself. And I took that $10,500, which works out to be, I can't remember the number from the beginning. So $10,500 divided by 12. 10,500 divided by 12 is 875. It was a little bit different. I rounded up or down. So 875 a month, I was just paying myself back instead of giving the money to the credit union or giving the money to M&T Bank or Key Bank or Bank of America or Wells Fargo. You get the drift. You're giving the money to somebody for your cars you're driving. Why not give it to yourself? That's all I did. So every single year, I was making my deposits up to year 10. Now, after year 10, I basically had to reduce my amount I was depositing. There's rules. There's IRS rules that we have to follow with these banking policies. And in year 11, I hit my MEC 7-pay rule. I could only put 7,200 in. So you can see the transition there. 60% less is what I could deposit after the 10th year. But up to 10 years, I was doing 18,000 each year. And then I was also writing that $875 check and depositing that back over into my cash value. So the net outcome of that is I put in $68,400 over those 5-year period right there. And then I also I repaid the car, $52,500, which is the cost of the car, $45,000, plus the interest that I would have given to the car dealership. I paid it to myself. So 68 plus 52.5 means into my banking system, I put $120,900. Okay. But I bought a $45,000 car. So there's the car that I bought. So the net amount that I put into my banking system for that 5-year period was $75,900. Now, if I put $75,900 into my banking system net, and I have $219,719 in my account at the end of 5 years, plus this car sitting in the driveway, which again, I had to sell this car, but I'm just showing you the numbers. That means that I got $1.53 back for every single dollar that I paid for that car. In other words, I made 53 cents on every dollar that I invested into that car. Now, does that ever work that way for you? Do you ever get $1.53 back for every dollar you pay for your cars? No, because you don't have uninterrupted compound interest, and because you're not taking back the banking functions of your life. You're giving away control of your money by making monthly payments to everybody else. Here, all you're doing, folks, is making payments back to yourself. Let's go one step further here. I want to really be clear about something because this is very, very important. Now, we get wrapped up in our numbers, okay? And you're seeing a lot of numbers, right? But it doesn't matter. That's how much money's back in my bank account, my cash value, after paying $52,500 for this car over a 5-year period. Okay, that's how much I paid for this car with interest. But I have all $52,500 back in that account. Why? Because I was the bank, folks. I didn't give $52,500 or $52,500 to Bank of America. I gave it to myself. But here's something that's interesting. When you're the bank, when you start doing this, you hold and control the rules. You know, there's an old saying, I think it's like the person who has the gold makes the rules. You have the gold. You're the bank. So when I got into hard times with this car, if I couldn't make a few of these $875 a month payments, what would happen? Does the bank come and take my car? Do I have to worry about a tow truck coming and hooking up to this car and peeling away my car because I didn't make my payments? Heck no. I literally look in the mirror and I talk to myself and I say, hey, going through some hard times. made some mistakes in real estate, going through some hard times. Listen, I'd like to reduce my monthly payments to $500 a month. I just can't handle the $875. Then the other face that's looking back at you in the mirror says, well, let me think about this. You know, you've been really good. That's a beautiful car. I'd hate to see anything happen to it. So I'm going to grant you that. You can pay $500 a month. And you look back into the mirror and you say, oh my gosh, thank you so much. You're talking to yourself. You're the bank, folks. You make the rules. If you can't make the $875 a month payment, change it, adjust it, take a couple months off. Ask yourself in the mirror if it's okay if you, your bank, gives you a lower monthly payment. I just showed this as an example of $875 because that's how much money you would give to the bank. That's how much money every single month you would have paid to a conventional bank. And if you couldn't make that $875, guess what? This beautiful whip that's sitting in your driveway goes bye-bye. And what else goes bye-bye? Your credit goes bye-bye with it. You see, the insurance company, when I take money out of my banking policies, they never ask me what I'm using it for. They never say, great, what Audi are you buying this time? They just send the money to my account. There's no questions. There's no credit apps. There's no credit pulls, nothing. I just got the money because I'm the bank. So this is my second car. In my second car, now, did I not get all the money back for every single dollar that I put into this car? I didn't just get all the money back. I got an extra 53 cents per dollar that I spent on that car. Now we're really talking. But you see, it doesn't end here, folks. What questions does anyone have on this up to this point before I get to now, not my car, but my wife's car, her push gift for our Viviana gift that God gave us, which is our little daughter. She's now 4 months. So let's see. What questions? Reallocating money while keeping it. I love that. David said, check that. Just answered my, okay, great. You're paying it back monthly to yourself, your banking policy, instead of giving it to someone else. Thank you, Adam. It was a fun car while it lasted. And then Elizabeth said, will it improve your credit when you are your own bank? Well, yeah, because you're not using the bank's money. You're using your own money. So will it improve your credit just because you're doing this? No. But will it improve your credit because you're using less credit from the banks? Yes. So it will help you there. But if you're focused on this system to improve your credit, you're kind of missing it. But that's an added bonus. It's an added bonus for this. Now, let's just say this is kind of an interesting thing. It's not this car, but I had a little incident with another Audi, an RS4 that I had, where I was driving it way too fast with bald tires. I was having a bad day, so I was pushing the car to the limit, and I was going around this sweeping corner in this beautiful fall evening or fall afternoon. I think I was pushing about 105 around. It was just a sweeping corner, and I lost control of the back of that car. The ass end of the car went out. And I thought for sure at that speed around this corner, I'm a goner. I'm dead. You ever had your life flash in front of you? Well, this is the second time. This is probably not just the second time being a snowboarder, but this was definitely that time where I thought it was game over. I felt the back end go at 100 and whatever miles an hour around this just very minor sweeping turn, beautiful sunny day in an RS4. I don't know what happened. I think I closed my eyes. I don't know. But the car corrected itself. Audis do that. They're all-wheel drive. I should have known that. You just hit the accelerator in an Audi and the damn thing straightens out. But at that point, I was scared. But let's just say something did go different. Let's say I was a goner. Let's say the car didn't correct and I creamed into, and it would have been the driver's side too, because I lost control around a right turn. So the driver's side hit a tree and I died. I graduated right then and there. What else? What would have happened? Okay. Well, I'll tell you. These policies, these banking policies, would have paid a death benefit to my beneficiary tax-free. So my beneficiaries, not that they want this car anymore, but the insurance would have fixed the car, but they would have had these cars in the driveway. They would have gotten a big tax-free death benefit. You see, this doesn't just stop with buying cars, but that day wasn't my day to go, nor was the time I crashed a Saab underneath a semi, but that's a whole nother story for another day, but I wasn't meant to go that time either. So we got an anonymous attendee asking, so this is your own bank. Is it an insurance policy account or just a specific type of bank? So that's okay. So you missed it a little bit ago. This is a specially designed and engineered whole life policy built for banking. This is not the regular whole life that you go to your insurance store and buy off the shelf. It doesn't even look like a regular insurance policy. Look at these numbers. Does a regular insurance policy do this? The answer is absolutely not. These are built for banking. So I hope that helps answer that question. Oh, and Junior, I'm sorry, I missed your question earlier. Junior was asking, what is the minimum? The minimum to do this is you take your age, okay? So I'm 43 now, age times 10, 430. So 43 times 10 is 430. That would be my minimum monthly. So that's the way you figure that out. So let's see. The other thing too, as Karen said, the beauty of this system outshines any car you can buy with it. Yeah, because you don't just have to buy cars. You can buy real estate. You can buy stocks. You can buy anything with this system, but we're just buying cars today. So let's go on to car number 3 for my beautiful wife, Larissa. All right. So the third car that I'm going to show you here, and I just got to click on this and get it going. Any day, computer. There we go. So, oh, and I didn't put that up there, but that's how much money I had grown my account. My account had grown $116,718. That's how we made that up. Sorry, I missed that part, but that's all right. So there it is. Okay. Porsche Cayenne, hybrid, all black. We had the rims painted black. It's literally right here. This is the day that I was in there. If you just came in late, I kind of did a role play where I'm talking about how I went in and I negotiated this car. I had a ton of fun. We knew we had this banking policy. We went into the dealership to buy a car. We didn't know if it was going to be this one. We were looking at Range Rovers and this. And I remember just going back and forth with the salesman, trying to negotiate the price. Finally, he slides the piece of paper over with the number that I can buy, which, right there, 1,083. And I'm looking at it and I'm like, all right, fine. Yeah, let's do this. Larissa's eyes light up. I think she jumped over and gave me a hug, but that might've been later. My mind's going wild on that, but she was excited because she was getting this vehicle and we negotiated the price with the dealership. We negotiated the monthly payment with the dealership. And then the dealership gets all the paperwork ready. And I'm like, no, we don't need the financing stuff. And he looks at me and he says, confused. He says, well, why did we go through that? Why did I run back and forth? I thought you needed to take a loan out. That's why we're doing this. I said, no. I just needed to know how much to pay myself back. You see, all I did is I used them to figure out the lowest monthly payment and the lowest interest rate that I could get on my vehicle. And then all I did is I set the system up this way. So here's how it works. So that Porsche, it's not a brand new one. I don't buy brand new cars. I've tried to buy a couple-year-old cars with lower mileage now, unlike my old Audis, which were nice cars with really freaking high mileage because that's all I could afford. But here we go. We're in the 13th year. Okay. So 13th year of this banking policy. So we're right up to current time. This is last year we bought this car. You can't see any snow, but there was snow in the bushes. This was right while winter was going on and we negotiated this car. So 7,200 is the amount that I'm now able to deposit into these accounts. So it's 60% less than what I started with. That's okay. I've got $185,000 in cash left in my account after I buy the car. So this 80,000, 185, I'd have to add 63,000 to it because the 63 that I took out was money that came from that. But remember, at this point, I'm still earning interest on the full amount in my account. So how much is the full amount? Well, if anyone remembers from the prior slide, we'll go back to it here right now. So I'm earning interest, come on, right there, on 219,000 plus interest and dividends, which is this. So I am earning interest that year on a full amount of 63,000 plus 185, 430. $248,430. That's how much I'm earning, 4% guarantee interest plus the dividend on. But I just repeat the process. I do the same exact thing as we've been doing. I take the loan from the insurance company. I buy this car for Larissa. She is absolutely thrilled. I'm going to try to draw this with a mouse. So she is so stinking happy. This is her long blonde hair. And she gives me a big hug. That's a terrible drawing. Ignore that. So she's happy. We get the point. And now what I'm going to do is I'm going to make monthly payments back to my banking policy every single month for the amount that I would have given to the car finance company, which was M&T Bank. And I just do that for a period of 5 years. And I only did this for 5 years because I'm not showing you the full amount because this is a 6-year loan that we did on this. But again, I'm the bank. I don't have to pay for 6 years. I can pay for as many years as I want, but I want to be an honest banker. So if I do that, here's the math. So over this 5-year period, year 13 to 17, which that's going into the future, that hasn't even happened yet. I've got $36,000 that I deposit into the account. I will have paid back $65,000 for that car for 63. And that might be a mathematical error there too. Here, let's do it. Folks, just understand we built this over the last week, but we really put the final touches on it last night. No, that's correct. 65,000. So we paid back for that 63,000, but that's only 5 years. There's another year on top of that because it's a 6-year loan. So you'd have to add 13 grand before the vehicle's paid off, but it doesn't matter. 36 plus 65 means the total deposits and payments back to my banking policy that I've made on that car, total 101. So 101,000 went into my banking system, less the car. So we got to take that $63,000 car out of that number. So the net amount is $38,000. Okay, 101 minus 63, 38,000. That's the net deposit and the cash value growth after the purchase of this car. So now remember, the way this is shown, not the way it really happened, but the way this is shown, well, you would have the equivalent of $3.22 back for every single dollar. So if you paid 63, you'd get $3.22 for every dollar you spend on that car. It's absurd. That is how powerful uninterrupted compound interest is. But you see here in buying cars, the one thing we really haven't hit on, we haven't really talked about yet, is I'm making money twice. I'm not just making money once. Sure, I'm making interest and dividends on the full amount of this account. So I'm making interest and dividends on every single penny that has ever been put into this account and that it's grown to. So that's the first part. But where else am I making interest? Well, if I went and I refinanced this car at a bank, I'd have to pay them interest, right? So the interest that I would normally give away to the bank is now going back to me as well. I'm making money twice and I'm getting the same results. Everything's exactly the same as what I'm doing today. Today, I'm saving money. Today, I'm making monthly payments for a car in one way or the other, or you're paying cash for a car, which means you're losing the earning potential of your money. You're already doing this. You just changed one thing here. And by changing that one thing, let me show you the net outcome of what actually will happen when you do that. Because it doesn't just stop right here at $3.22 back for every dollar, or the fact that your cash value growth grew by $122,000 because of that compound interest and the interest that you're paying yourself back. See, it gets even better. So during this period of time, I didn't pay the interest to the bank. So I gave the bank zero of my money. I controlled all of my money. Second thing that I did, the interest paid to me was $16,481. Now that's just the interest that I would have given away to the bank, the interest on those 3 cars. And I apologize, the one car is missing. There it is. So the interest that was paid to me was $16,481. That $16,481 would have been paid to someone else's bank. But because I changed the direction of where that interest went, now it went to my bank, I put $16,481 into my banking system. But most importantly, I have all that money in the banking system. $3.22 back for that last car that we bought. And you see these 3 cars, had I not sold them, they were all bought and paid for. Well, the Porsche's not, but the other ones were all bought and paid for. I would have gotten all those cars. They could have all been in my driveway. I could have gifted them. I could have given them I could have held that little black one right there in the middle. I could have kept that for Vivi. It's not what I did, but I'm just saying, you control the cars because you own the cars. You control the interest because the interest went to your account. And you were also in control of uninterrupted compound interest on your money. So with that being said, at the end of the day, my way is just like this photo. You guys have seen Dumb and Dumber. Just when you thought you couldn't be any dumber, you go and do something like this, and you totally redeem yourself. All you did to redeem yourself is change where that money went first. All right, folks, with that being said, I have to get to my next call, and I hopefully will speak to some of you, and I hope you guys all enjoyed this, and we will have more for you very soon. Enjoy your day. Thank you for joining me for another wealth webinar series, and I'll have more for you on the next one. We'll see you soon.